Hello learners, and welcome to Manifested Publishers online revision classes. My name is Nicholas Sikali. We want to continue the revision by going to question 4 of Financial Reporting, August 2022. Now, the question had two parts. There was part A and there was also part B. We are going to start with part A, then we'll proceed to part B. So the question reads, on 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for a 3-year period. The terms of the lease were that Breakwood Limited was to pay 500,000 shillings each year, with payments commencing on 31st December 2019. Initial direct costs incurred on the lease amounted to 30,000 shillings and were paid for by Breakwood Limited. The plant and equipment had a remaining economic useful life of 5 years at the inception of the lease. The lease contract did not contain any purchase option for the lessee. Breakwood Limited can borrow at a rate of 10% per year. Required. Analyze the accounting treatment of the above lease transaction from inception for the 3-year period of the lease contract. So this question is concerning IFRS 16, which talks about leases. Remember, this was transited from IAS 17, which also used to talk about leases. But now, according to the subsequent or the amendment that were done, now we'll be following the requirements or the requirements of IFRS 16, that is leases. Now, to account for this lease from inception, that means that we are supposed to, 1, compute the lease liability, and 2, we are supposed to compute the value of the right of use asset. Remember, according to the provisions of IFRS 16, a lease will be accounted for as a finance lease unless the lease is of low value. So if the lease is of low value, then it will be accounted for as an operating lease. But otherwise, all leases will be accounted for as finance leases. So workings, and our first working, we want to get the lease liability, which have not been given here. Lease liability here will be the annual lease payments, that is the lease payments times the present value interest factor of annuity R% N periods. That means you take the annual lease payments and discount them back to the present by using the present value of annuity. Remember, we are using the annuity because the lease payments are made at shillings 500, which is constant per annum. So we are going to use the present value interest of annuity. The annual payments, the lease payments were 500. That is to be multiplied by the present value interest factor of annuity. We were given the discounting factor or the borrowing rate, which is 10%. So that will be computed by taking 1 minus 1 plus 0.1 raised to power negative 3, because a period of 3 years. Then we divide that with the R, which is 0.1. This will give us the lease liability, and the lease liability will amount to the following, and that is 500,000 times 1.1 raised power negative 3, 1.1 raised power negative 3, 1 minus answer, divided by 0.1, which is 2.488685. Can use with 85. That will give you a lease liability of 500,000 times answer 1,243,425.995. So that is the lease liability at inception, which follows up with the computation of the right of use asset. So how do you get the right of use asset? Right of use asset. Right of use asset. So with the right of use asset, this will be the computation for the right of use asset. The right of use asset. Now we start with the lease liability. The lease liability. And the lease liability amounted to 1,243,425.995. Add, from that we want to add the initial direct cost, initial direct cost, and the initial direct cost amounted to 30,000. So 30,000. Before we get the total, we are supposed to deduct any lease incentive, less any lease incentive if given. Any lease incentive, this one is nil, so we were not given any lease incentive, then this will be the right of use asset. The cost of the right of use asset will be what will be given here. Right of use asset. Right of use asset. Now the right of use asset will be what you have plus 30,000, and your right of use asset is 1,273,425.995. That is the value of our right of use asset. So once we have the right of use asset, and you also have the lease liability, our next option is to see how they are accounted for at inception. So we want to see how they are accounted for at inception. Accounting treatment at inception. Accounting treatment at inception. Accounting treatment at inception. That's accounting treatment at inception, which means that we will be debiting a few things and crediting others. So with the right of use asset, of course, you debit the amount, debit right of use asset of use asset. We are debiting the right of use asset, and the amount that you are debiting that is maybe we are debiting it with 1 million, or because of space it has come up with a more clearer way. So debit and credit. So we have right of use asset, right of use asset. We are debiting 1,273,425.995. You debit the right of use asset with that amount. Then what are we crediting? We are crediting one, bank. There's amount that was paid in bank. The initial direct cost of 30,000. The initial direct cost of 30,000 will be credited. Then you also credit the lease liability. Lease liability. The lease liability amounted to 1,243,425.995. So that is also to be credited there. So if you, at inception, that is the first thing that they did, they debited the right of use with this amount. Then they credited the bank because they paid initial direct cost of 30,000. Then you also credit the lease liability of 1,243,425.995. If you add these two, of course, this journal will balance. That is accounting treatment at inception. Accounting treatment at inception. What follows is subsequent measurement. Subsequent measurement. Subsequent measurement. Subsequent measurement. And according to what the IFRS presents or provides, after the initial treatment at inception, then the second thing is that the right of use asset will be depreciated annually, of course, on the straight-line method here. Then another thing that will be happening subsequent to the initial measurement is that the lease liability will have to be amortized. So we'll be doing the amortization schedule so that you can see how the lease liability will be amortized. But before that, let us calculate depreciation. Depreciation per annum is going to be as follows. We have the right of use asset amounting to 1,273,425.995. Just divide that with 3 to get your depreciation charges per year. That will give you some answer. That is 273,425.995 divided by 3. Depreciation per annum is 424,475.33. That is 0.33. 475.33. That is depreciation per annum. So that is 1273,425.995 divided by 3. It's 424,475.33, and perhaps 17 at the end, but it can stop there for that thing. That is depreciation that will be provided annually. When we have the amortization schedule, we also want to do the amortization schedule. Amortization schedule. Amortization schedule, because we said subsequent to the initial measurement, the asset will be depreciated, then the lease liability will be amortized. So the lease liability will be amortized. So this will be this way, and we have a long schedule here, very long schedule for 3 years. So here 1, 2, 3. So we have 3 years. Perhaps should have that for 3 years. 3 years. So here, opening obligation. Opening obligation. Opening obligation. We have finance cost. Finance cost. We have installment, the annual installments paid. We have principal. And finally, we have closing obligation. Closing obligation. So we have closing obligation, we have principal, we have installment, we have finance cost, and we have opening obligation. For installment, this one has been given as 500 through 500,000, 500,000, and 500,000. That is constant for installment. The beginning obligation of the lease liability the beginning obligation of the lease liability is 1,243,425.995. So finance cost is at 10%. Finance cost is at 10%. So 1,243,425.995 times 0.1. That is 124,342.59, and principal will be 500,000 times answer. 500,000 times answer that you have here, 375, 657.4005, that is 0.4005. The closing balance is the opening balance, of course, minus the closing balance, minus the principal, that is 1243. 425.995 minus the answer 867, 768.59, 768.59. So that will be 867, 768.59, because the other one is 45 on the other side, times 0.1, which is 10%, 86, 776.859, then 500,000 minus that answer, 413, 223.14. So 413, 223.14. Then we are going to take 867, 768.59 minus that answer. You get 454, 545, 545.44, 44 cos 95, so 454, 545.44, it is 95 on the other side, 4495 times 0.1, we get 45, 454.54, it is 0.54495, I've abbreviated that. So 500,000 minus the answer to get the principal, which is 454, 545.45, 454, 545.45. And looking at what we have here to get the principal, that is usually opening obligation minus principal to get the closing obligation. If you minus this with this, the answer will be 0, that is 454, 545.45. If I round this one off, it will be 0.45 minus answer, it is 0, and the answer here will be 0. So that's how we run amortization schedule for a loan where the payments were being made in arrears. Remember here, the payment were being made in arrears and not in advance. According to what we had in the question, the payment occurred, or the first payment occurred on 31st December 2019. Remember, the financial year started on 1st January 2019 when the lease started, but the first payment was done on 31st December. That is payment being done in arrears. If payment are being done in advance, that will be a different story. The amortization schedule will change slightly if the payments are being made in advance. Once you've amortized, we now want to move to our financial statement extracts for the 3 years. So the financial statement extract for the 3 years, that will be Breakwood Limited, Breakwood Limited, Breakwood Limited financial statement extracts, or statement of profit or loss extract, statement of profit or loss extract for the 3 years, that is 2019, 2020 and 2021, the financial statement extract for those 3 years. The first thing will be depreciation, and of course the other thing that they will present will be finance cost, depreciation and finance cost. So we have depreciation and finance cost. Looking at our schedule, we have finance cost. Looking at our depreciation computation, we can bring in 425, 475.33, that will be constant, or can just use 475.33, again 475.33. That will be our depreciation for the 3 years, 2019, 2020 and 2021. That means we'll be debiting depreciation, of course, and we'll be crediting the asset or accumulated depreciation. Finance cost from our amortization schedule, this is 124,342.59 for the first year. For the second year, which is 2019, that is 776.85. Remember, second year represents 2020, first year represents 2019. The last one is 454.54. So that will be what will be presented to the statement of profit or loss for those specific years. Since it's an extract, there will really be no need of summing them up, but if a summation is required, then you just sum them up and get the totals. Breakwood, again, Breakwood Limited, statement of financial position, statement of financial position extract, statement of financial position extract, again for 2019, 2020 and 2021. That is the statement of financial position extract. We could differentiate the two. So we go to the statement of financial position extract. The first thing is non-current asset. The non-current asset, we have the right of use asset. Right of use asset. Under the right of use asset, we computed the value for the right of use asset in our workings there to be 425.995. That will be the same through. This is 1273, 425.995. Same thing to the far end. Maybe I should round them off so that they can fit on them on my board, or 1,273,425.995. So that will be for my 2021. Accumulated depreciation. Accumulated depreciation. Accumulated depreciation. We have calculated depreciations here for 24, 475.33, and for the second year it will be 475.33 times 2. This is 848. 950.66. What if we multiply with 3? It is 1,273,425.99. So that would be depreciation, accumulated depreciation, which will be deducted. This is 0. That one should be 0. This is 425 or 424. 475.33. Of course, this one will be 848. 950.66. So we are deducting from what we have below here. This will give you your net book value for the right of use asset. So this will be net book value. Net book value for those right of use assets. Once you have the net book values for the right of use assets, we move to non-current liability. Non-current liability. And we also move to current liability. Current liability. Current liability. Of course, we have the lease obligation. Lease obligation, and you also have the lease obligation. Under each, of course, the lease obligation at the end is divided into the non-current liability portion and also the current liability portion. Now, looking at our amortization schedule, the liability for 2019, the lease liability for 2019, the total lease liability for 2019, which is year 1, amounted to 867,768.59. That is the lease liability for 2019. If you are presenting it as one figure, obligation just for one figure, that means we'll be using 867,768. But it's usually a very good practice to separate this obligation at the end of 2019 into two portions. That is the current liability portion and also the non-current liability portion. Now for the current or non-current liability portion, the 867,768.59 is made up of two portions, the non-current portion and the current portion. This figure is made up of the principal here of 2020 and the closing balance here of 2020. That means when you take this and you add to this, you'll be getting the 867, which is the obligation for the year 2019. So if you want the non-current portion, you move a year down, and you want the current portion, you also move a year down, which means that you are going to use 454, 545, 545.44. The current portion will be 413, 223, point, I believe that one was 0.4 as well. That one was 0.4. If I'm not wrong, that was 0.4. If you add these two, you are going to get the obligation. That was 0.45. 0.45. You are going to get the obligation up here of 867,768. The same case for 2020. The total obligation for 2020 is 454,545.44. That is for 2020, presented by year 2 here. 454,545.44. That is the total obligation, which is divided into two portions. the current portion and the non-current portion. So the current portion is the principal, while the non-current portion is the closing obligation. So we don't have the non-current portion because it's 0, while the current portion is now 454, 545.45. Can see, if you add this plus this, you get the obligation for the year 2020, which was the total of 545. Now there are those who will present as one figure. That's just a lease obligation as one figure, and if that is the case, then it means for 2019 you bring a lease obligation of one figure of 867. For 2020, one obligation for lease liability of 545. Then for 2021 there will be no lease obligation since you have 0. But it's a good practice to always separate them into the current portion and the non-current portion. For 2021 there will be no lease obligation. As we can see, it is 0, and therefore it means that there will be no lease obligation, whether non-current or current, in the 2021 year. So that is how part A of the question was supposed to be handled, and we've shown the accounting treatment at inception. Then we've shown for the 3 years the subsequent measurement in terms of depreciation and amortization schedule, how that is going to be reflected in the financial statements for Breakwood Limited, who was a lessee for that matter. We'll now be proceeding to the second part of the question.